What are you telling your peeps? I know they're calling. They've got to be calling saying, what are we supposed to do? How much worse do you think it's going to get? What's the best strategy? What do you say?
Well, Scott, as you know, we've been negative since all my appearances on halftime. We've been negative all year, and events have been unfolding as we've been looking for. In February, after Putin invaded Ukraine, we put out a client note saying if the markets survive Putin, they still have to deal with Powell. And that's exactly where we're facing right now. So we don't think it's a time to get aggressive or add equities, even though prices have come down. We're in the midst of a period where the monetary landscape is changing, and investors should focus on the return of capital versus the return on capital.
So you're as negative as you've been. You want to use any sort of rally to reduce positions that you may still have?
Yeah, absolutely. So we've had nearly 15 years of an environment where there hasn't been a market-determined level of interest rates. And interest rates are the traffic signals that basically control the monetary highway. And they've been flashing green for years. That's led to a lot of leverage, excess speculation, and rising asset prices. Now everything's turning. So in that turn, it's changing the dynamic of valuation, and that's what we're facing right now.
Well, how much worse do you think it's going to get? I mean, you're painting a pretty nasty-sounding scenario.
Well, lots of talk about recession, okay? So we've got
You don't think we priced that in?
Not yet. You know, even though we've had 2 quarters of negative GDP growth, 6 months of declining leading economic indicators, we've got credit card debt up 18%, housing is slowing. We're slowing, but we're not yet in recession.
Labor market's still really strong.
Labor market's strong, and our expectation is that companies will be slow to lay off workers because there's a labor shortage. But nevertheless, expectation for earnings are going to go lower.
You like bonds better than stocks?
I like cash better than everything right now.
You have more cash now than you've had in how long?
Forever.
Really?
We have the highest cash positions we've had in years. Look, let's look at the market. Let's look at valuation. There's sales, there's margins, and there's multiples. All three are going to have to come down. So sales have been elevated because inflationary push has gone through to consumers, but that only lasts for so long. Margins will be under pressure simply because of inflationary pressures and labor costs. And then multiples, you know, where are they going? Multiples have to be reset lower. So put 15 times on 220 earnings on the S&P, and you're at $3,300.
Oh, but you're still getting to 220. Some people have $200.
Yeah, Trenard's out for 200. There's others that are all over the place. But look, if we can look at different levels of market declines, 3,600, the market is probably a little bit overpriced. 3,300, I think you start looking at the market. If it ever gets to 3,000, I think stocks will be trading very attractively.
So when I asked you about bonds, I mean, specifically, you told our producers, avoid getting lured into the 2 or 3 year treasuries. Like the 2-year treasury is one of the hottest trades of the year.
Yeah, here's why I'd avoid it. If we get a recession and rates start moving down, the 2-year will get caught right in that downslope of interest rates. I want to have shorter-term treasuries, dry powder, let's say anywhere from 1 to 9 months, because I want to start adding municipal bonds right now.
So you like those specific, like what's the best muni that you've seen? I mean, I've seen some crazy ones with like 5% coupon. Of course, the maturity is, you know, from here to eternity. You have to wait. But what's the best?
Well, look at it this way. We're buying kicker bonds, meaning that they have a longer-term maturity, let's say 20 years, but they also have a call feature in, let's say, 8 to 10 years. So right now, with a 5% coupon, the yield to the call could be 380 to 420. And if it's not called in 8 to 10 years, then it kicks to, let's say, a 450, 475 yield. If you look at a 450 yield, after that's a tax-free rate, and you look at the market over the last 40, 50 years, the average return, let's say 8, 9% over the long term, that's 4.5% after tax. So you can basically construct a portfolio with long-term market returns without that kind of volatility by approaching the muni market right now.
Speaking of constructing the portfolio, last question, 60-40. Ken Griffin defended it yesterday and says it looks much better today, really, than at any point in recent time, is what he said. It sounds like you disagree with that, unless 60% is cash and 40% is split between stocks and bonds.
Well, it's all about timing. So 60-40 didn't work this year. It's down 18% because the fixed income component, which normally supports the equity risk, was starting at a 0 interest rate. So now that rates are higher, there's less duration risk in owning bonds in a 60-40. So I'd certainly consider that an asset allocation.